to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome back to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof, and today I am joined by Peter Neill. Peter, welcome to the show.
Mallory, thank you for having me. It's an honor to be here.
Great. Well, Peter, we were talking a little bit offline, but why don't you give our listeners a little bit of background about how you ended up into the real estate space? And then I know that I want to take this a couple different directions, so I'll let you take it from here.
Awesome. Well, it was kind of by chance. I didn't set out to be in the real estate world. And actually growing up, my father was a facilities manager, property manager for CBRE. So growing up, I remember him taking me to different locations, a lot of office and industrial and some retail and stuff like that. And he was a property manager, and I did not think that was the life I wanted. It was it was a lot of I can still remember when it was storms and bad weather and things like that. It'd be 2-3 o'clock in the morning. I'd hear him in the other room on the phone, that kind of thing. So in my mind, I thought, I don't know if I want to get involved in real estate. And I went to Temple University and studied broadcast telecommunications, mass media, with a specialty in media business. So I did a lot of internships in media and TV and radio, and I thought that's what I wanted to do. And soon after school, I ended up taking a job at a distressed mortgage investment company that was advertised to me as a real estate investment company. And it was a boutique firm that was growing a ton. And I was really fortunate to kind of be the right-hand man to the CEO of that company. And he was a prolific investor well beyond just the distressed mortgage company and that. So he really introduced me to single family rentals. Like a lot of what we do today was introduced to me through him, because he did a lot of the same stuff in his own portfolio. And then we also ran networking groups for high net worth investors where we brought all kinds of different investment opportunities in. So I was really exposed to, you name it, anything from self-storage to car washes and industrial, retail, and everything and anything come through that group, and saw people make presentations and all. So my background was really, and my focus was really raising capital, structuring funds, raising capital, and then operational oversight, putting the right people in the right seats. Corporate strategy is kind of another, name for it. Is just, kind of looking at defining what the vision is, and then devising a plan to get there, and then bringing the right people in to make that happen. So it was about maybe 6 years ago or so, I branched off and co-founded a company called GSP REI. And today we focus primarily in two paths: on single family rentals, acquiring existing, primarily distressed, something we can add a lot of value to, and then typically lease and hold it as an SFR, as a single family rental. And then we're also in the land development space, where we're looking to entitle raw land for residential communities that we can keep and hold long term for our buy and hold portfolio, or feed the builder machine at the end of the day. So entitle it and sell it to a builder, and kind of be out of it at that point from there. So that's my focus.
Love it. You got a lot of things in the pipeline then, it sounds like.
It's all single family focused. I mean, that was one thing for me. I see a lot of people do all kinds of different stuff, and I think that's right for some people, but probably not the best for a lot of people. You know what I mean? I think this is the kind of business, and I think that's one of the fun things about this business, that there's so many things you could learn, and November will be my 11th year in the business, and I still feel like I've barely scratched the surface. I'm always learning something new on a any day of the week. So I think that's one of the fun things about it. But even like a topic like single family rentals, I like to take it as narrow as possible, and really focus in and understand the intricacies of that. But there's so many different ways you could take that, from like an SFR, to a rental, to a fix and flip, or distressed mortgages, which are collateralized by it. There's private lending. There's obviously, the entitlement and all the stuff that goes into creating new residential communities. So there's so much you can do in this space. And I've kind of decided, and the team and the company and the platform that I'm building is very much targeted for single family rentals. So whatever we do, it's pretty much going to end up as something we're holding long term as a buy and hold, or something that we're going to sell, ideally for a profit in the short term.
Got it. Okay, so you have a lot of moving pieces within what you do. And so I want to take a second to understand exactly what your role is, and then the people who you've brought on as part of your team to try to help potential investors understand how important it is to building your team and understanding who is going to be doing this role for you and who's going to be doing that piece. So tell me a little bit about how your team is structured and some of the recommendations that you would maybe give somebody else who's looking to get into single family rentals.
Yeah. And you know what I'm talking about applies to anything, like it's just a fundamental. Real estate is a team sport at the end of the day. Even like something like development can be very, what I'll call like lean and green, in the sense that you don't need a huge team to do it, but you're going to need a lot of outside, third parties, different attorneys, engineers, land planners, designers, architects, you name it. There's all construction, property management. There's all these other pieces that you need. So for me, my introduction into the business was the company I work for. They had three partners, and they all kind of had their lane. And that was something that I understood it, and I saw it and how it worked in real life there. And that's what I wanted to replicate with GSP. So, my background is not really in construction or, property management. I bought my first property, I think I was 23 or 24, and I did all that myself, and I learned a lot. I think it's one of those things where if you can and you have the opportunity to kind of get in every side of the business, you should do that, because you're going to see it from all the different perspectives. I think you hear that analogy in like the restaurant space a lot. It's like, if you want to own a restaurant, you want to get in the front of the house, back of the house, all that kind of stuff. And real estate's the exact same way. If you can expose yourself to all the different aspects of it, that's important. But chances are there's going to be a piece of the business that resonates with you and your personality and your skill set more so than others, because there's certain, like a lot of what I do is structuring the fund, raising capital, so dealing with the investors, and then bringing people onto the team and partnering with people who are really good at what they do. So like when GSP started, my partner Ron Lockhart had been in the construction business for over 20 years. There were guys on the crew with him that have been with him for 15 plus years at that time. They're still with us today. So that was something I couldn't replicate that myself. You know what I mean? And I understood, owning the duplex at that time, that was what I needed. You know what I mean? Because if I want it to scale, if I'm calling other people, I have one property or two units, it's just, you're not a priority. You know what I mean? And so it's just, I felt like, and this was full time for me, right? This is what I was doing at the time at a company, but what I wanted to do, full time for myself. So the way I looked at it was, if I really want to get there sooner than later, I need to partner with somebody who has that. So he had the construction down, from there, kind of the property management, just the natural, having the crews to do maintenance and stuff like that. And then we've put a lot of people in place, so we have guys who are running the construction on different levels, people who are running the property management at different levels, from leasing to tenant, maintenance calls and things like that, in different areas too. Like, we have properties in Philadelphia and the surrounding suburbs, stuff in South Jersey, stuff in Baltimore. So different people that are leading, different, geographical areas. Mm-hmm. And then that was the same approach I took to land development. I partner with somebody who's 21-year land development veteran, was at a couple of the nationals, was with some regionals. So all kinds of different experience on how it gets done from a corporate level to how it gets done, on the more smaller regional perspective. And then same thing, just structuring a offering that you're going to have the best chance of raising capital from investors in the marketplace, that kind of thing. It offers the returns and it has the alignment with investors that they're looking for and that kind of thing. And then building the trust and doing all the investor relations that goes along with it, while supporting the people that you put in place from an oversight perspective, from a kind of the market perspective. What do we see? What do we need? Where should we be allocating our capital to geographically? With different, there's all little intricacies into projects, whether they're larger construction projects on like the redevelopment side or smaller. So a lot of it has just been, putting the right people in place, overseeing it, and then putting a structure and raising capital around that structure in place, and just taking it from there. And as I said, we said offline, just a corporate strategy, like kind of having this vision and this goal, and then putting the people and taking the steps to get there, however quickly you want to do it.
Yeah, no, and I think that's so important. So I'm curious, how did you find these people to get them on your team? I think that's probably one of the biggest challenges that, especially new investors have, is like, how do I find these people that I want on my team? How do I go out and find a veteran who's been in the industry for, 20 years? And how can I meet these people to put myself in the best position?
Yeah. So networking, I was really fortunate with the company I was at before, that I had this unbelievable network of people. And one of the people I knew there, he had a bar. He sold the bar. He made a lot of money on the liquor license and the building. And he left and he was flipping houses, and his father owned a bar. His father sold that. His father made a lot of money. It was a wah-wah deal. He really did well. And they started buying houses together. And I was talking to him about, what I was doing on my own with real estate, what he was doing. And he said, we got to get together, let me show you what the operations, that kind of thing. And they were kind of tapped out on personal money and family and friends money at that time. So he knew what I did and all. So I think he wanted to get together in that sense as well. So when we got together, there was also, I was looking at it, this is a whole story, but I was looking at a sports development, sports complex development locally too, where we were going to put some turf down and lease it to schools and stuff like that. And he played minor league baseball, and he coached one of the colleges around here. So that was one of the other reasons we were talking. And he said, well, the contractor that was doing all of the work for him on the fix and flip side of things, and some of the rentals they were doing at the time, he sat on a board of a sports marketing company. And the reason I'm telling you like some of those details is because you never know. You know what I mean? It's just funny sometimes how life will just put you in touch with the people you need to be in touch with at the time. You need to be in touch with them. It's kind of like the stars aligned. Yeah. So we got together, and he actually owned a piece of a CrossFit gym at the time too, and we met up there and got to know each other. And I wanted to see some of the projects they were working on and stuff like that. And as I got more intimate with their systems and processes and how they were managing the jobs and all that, I was very intrigued. And a lot of what they were focusing on was kind of workforce, affordable housing, so property values in this area under like 300, 450, that kind of thing. Rents in the 12, back in those days, God, it was probably 12 to 1500 range, or maybe even a little cheaper. And that was a place that intrigued me, because I was used to it with the boss I was at before. He had a lot of that type of housing. And I knew that you could make a lot of money that way and be very successful with doing that. So we kind of just started spending a lot of time together, and I had what I could do. They had what they were doing and could do. So there was that relationship there. You know what I mean? So my advice there would be, it's just, I'm typically not one to turn down a meeting. I always entertain a coffee or a conversation, a phone call, just because you never know what's going to come from it. And I think a lot of people are either they're intimidated to do that they don't see what maybe they can get out of it, so they don't do it or whatever. And it's just, you never know, when you actually talk to somebody and you have a conversation, what you're going to have in common with each other, and that could be, God, it could be so many different things. You know what I mean? That somehow sparks something, so from there, on the land development side, we were actually looking for kind of what they call contractor leftover. So we were looking to buy from local builders a portfolio of single family homes that, they have like these large communities where they sell 90% or 95%. And then the last few kind of maybe sit around a little bit. So we were going to go in and purchase a portfolio of those. You can get them at a discount to market because you're coming in and buying a bunch of them. And we couldn't make something work there, but we ended up, it was just really liked each other, and the relationship kind of grew from there, you know what I mean? And it's one of those things too, where it's like, the more you do it, the more you can realize, and this is the same thing with like screening tenants, the more you do it, the more you can realize who's a good person, genuinely a good person who means to do well. And then there's, and then you could usually tell who's maybe pardon my French, but a bullshitter, I mean, somebody who's just not, not the nicest, or doesn't really mean well. And then there's a number, and we can get into that conversation. I mean, there's a number of things that I look for with kind of solidifying that relationship. And it's not something that I take lightly, and it's not something that happens quickly either. It takes a while, but you got to find a way to add value. You know what I mean? Like,
absolutely. And I think you're spot on with, the point of never turning down a meeting, because you never know where that meeting might potentially bring you. And, I tell all of my students that you should never give up a networking opportunity, because, for me, like the job that I have currently, I kept in touch with a former professor, and that's how I kind of full circle got back here. And so, it's simple things like that, with just staying in touch with people, asking them how they are, what they're up to, telling people what your plans are so that they know what you were up to. And if the, paths align, that's a great way to, build relationships that might not have existed previously.
100%, and the younger you are, it's actually the more power you have in that sense. I mean, because you don't know what you don't. I can still, some of the people that I cold called back in those days, just because I wanted to talk to them, I think now I just think, I can't believe I cold called that person. I mean, they're worth like, $1 billion, or hundreds of millions of dollars. And it's like, what the hell was I thinking? But it didn't, and they actually pick up, what I mean? Because chances are a lot of the investors that are really good at what they do and you look up to, chances are you can get in touch with them, and they will pick up, because they probably understand that as well. And maybe you have to jump through some hoops. You talk to a secretary or, executive assistant or something like that. But you'd be really surprised the amount of people that'll get back to you. And then, or just pick up when you call them. So probably because they're thinking the same thing. You never know when that opportunity is going to be. And it's such a huge differentiator in the space, for your own personal brand. When you pick up the phone, when people call you, or, if you can't do it in the moment, you call them back in a relatively quick manner. It's just, so many people don't do it. So it's such a way to stand out. And, especially in this, where it's such a relationship business, depending on who you're, if it's an acquisitions thing or a construction or property management thing or whatever, it's, if you do that, if you do it, people will tend to feel obligated to do it for you as well. Yeah. So it's just like, you get back to people quickly, you'll find that sometimes they'll reciprocate that for you.
100%. Okay. So you built this team around you, you built this company. Dive in a little bit as to kind of like the people who you're targeting. I know you said accredited investors, but you're doing a lot of syndications with developments, with entitlement, and then also single family. So give me an idea of what some of the investors that you have, what kind of returns are they getting? What kind of, expectations are you setting? And people who are unfamiliar with what a syndication might be and funds, give us a little bit of background about that.
Yeah. So essentially, in order to do what we do, whether it be buying a single family home and fixing it up to lease or to sell, or putting a raw land under contract and just to take it through the entitlement phase, in order to do it, you need to have money. And so what you can do, there's a lot of different ways you can get money, and there's a lot of different ways you can structure on how to raise capital, that kind of thing. But what we've done and what I do and what I've always done is through 506C Form D fund offerings. So it's essentially, that's just what you do with the SEC. You file a Form D, and then we work with a securities attorney to put together a private placement. The Form D comes after the private placement and all. But the private placement just essentially is your business plan. It's here's what you're going to do, and then it's the operating agreement that joins the investor to the entity that's going out and buying assets and things like that. There's a subscription agreement, that says how much you're investing and all your information, that kind of thing. So, but at the end of the day, it's you're pooling capital together to achieve a business plan. And because of the way that we have the fund structured as a 506C, we can generally solicit. So we actually I can answer those questions about the fund and the returns and things like that. Whereas if it was a 506B, that's kind of like a friends and family fund where, you have to have a pre-existing relationship, that kind of thing. But for us, we kind of have two different structures, one for the single family side and one for the land development side. And, from a return perspective, on the single family side, we have it structured kind of like private credit. So we pay a fixed rate of return for a fixed period of time. It's between 10 and 12%, depending on how much the investor invests with us, what kind of term they want to sign up for, that kind of thing. And then we pay a monthly dividend to them, and at the end of the term they have the ability to take their principal back, or they can keep it rolling, whatever they'd like to do. So it feels very much like private lending. People a lot of times will lend money to third parties. When people work with us, we're not lending the money to another operator. We are the operator. We do the acquisitions, the construction, and then you continue to be collateralized to the rentals at the end of the day, because most of what we do is rentals. On the land development side, that's more of a traditional equity. We have a 10% preferred return on it, and then we split the profit 80 and 80-20. So 80% goes to the investors and 20% goes to us as the managers. It's a European waterfall, so meaning 100% of capital goes back to the investor to kind of replenish their principal investment, and then from there they get the full 10%, and then we split the profit 80-20 from there. And what we target in that fund is a minimum. We'd love to see the investors get a minimum of a 2x equity multiple. So you invest 100, you get 200 back. And we like to see a minimum 20 IRR in about a 3 to 5 year time frame. And the thing with land development is I don't think there's another strategy that has as much upside potential as land development, because you're really in it at the ground floor at that point. You're taking a raw piece of ground, you're securing the entitlements, just essentially that's the approval and the permitting and all with the local municipality that piece of ground sits in. And there's a lot of value creation there. And there's a lot of off ramps too. You know what I mean? So a lot of what we target for that is kind of feeding the national builders machines that they've built. A lot of deals around here in our markets, which is kind of the greater Philadelphia area out to southeastern PA, northeastern PA, and maybe some parts of central PA as well that we would look at. A lot of those deals pencil from a build to hold, or I'm sorry, for a build to sell perspective. So feeding them to builders is a fantastic way to do it. And then strategically, if there was something that would make sense for us from the long-term buy and hold perspective, we would love to keep that and develop it internally ourselves and provide some diversification within our single family portfolio, as what we do on that side is very urban, metropolitan driven, in the city of Philadelphia and the city of Baltimore, and some of the pockets in South Jersey, not so much city, but close to, depending on where you're at, that kind of thing.
Love that. So for investments that are existing single family, because I think that the ground development, that's where your numbers are coming in about a 2x multiple with, a 20 IRR and, 3 to 5 year hold. What could somebody expect if they went with the fund that's already existing? And do you do value add, or what's your strategy with those single family portfolios?
Yeah, so the way that we have it structured with the investor, it feels like private lending. I mean, so it feels like debt. I mean, so they would get it between 10 to 12%. That's either paid out. It's per annum. So the 10 to 12% is on an annual basis, and distributions get made to their account monthly. And they could compound as well if they want a greater return. It's common in the IRA accounts where investors maybe don't need the monthly distributions and just want a greater return with no UBIT. A lot of times private lending funds utilize leverage. They'll raise money and then they'll use a line of credit to lend it out. We don't do that. So a lot of people like to compound in the IRAs. So it's just essentially between a 10 to 12% fixed rate return. For us on the back end, we do very, very heavily lean towards very strong, very large redevelopment projects. I mean, so something, and the small properties, but just a lot of renovation work, I mean? So something we can buy, $30,000-$50,000, row home in the city, that we can pick it up in that price range and then put somewhere between 80 to $110,000. I mean, it'll be all in for about 130 or so. And then right now we're seeing appraisals upwards of 200,000 or so. I mean, so it's been unbelievable last couple of years. And then essentially like a BRRRR method. So we'll purchase it in cash, renovate it in cash, and then put a long-term 30-year fixed, 30-year AM mortgage in place. And then either that creates liquidity for the fund if we want to pay an investor back or need to, or we can just kind of rinse and repeat from there. But for the investor, it's a fixed income play. I mean, so for them, it's 10 to 12%, depending on how much they invest in the term. And that actually reminds me of one of the questions you had asked me, like from an investor standpoint, when you do a 506C and 506B as well, for the most part for them, it's accredited investors. 506B allows for maybe 30 or something like that, non-accredited. But 506C requires that they be accredited. And that's a term defined by, it's the IRS, and they have to have 200,000 in income as an individual, or 300 with their spouse if one doesn't meet the 200 individually, or you could have $1 million in net worth, not including your primary residence. There's a few other ways that you could qualify for that, but that tends to be the ones you see the most common.
Yeah, no, definitely. And I'm assuming that the entry level for some of these investors to get into is probably a minimum of a 50,000 investment.
Yeah, it varies. On the land side, we ask for 100,000. On the single family rental side, we actually do as low as 10,000.
Oh, okay.
And on average, for the higher returns, it's a 50 minimum. So 9 out of 10 people come in at the 50 minimum. It really typically more than that, but the 10,000 is there because this is one of those things where it's 50, 100,000. That's a lot of money to ask for somebody, especially if you don't have a pre-existing relationship, or they're not referred, or they just heard you on a podcast, or they met you at a conference or something like that. So it's a way for us to say, here's, I hate to say not a lot of money, but not a massive amount, not $100,000 or something like that, to kind of start the process, the relationship, because it's one thing to kind of watch on the sidelines, which a lot of people do, and I do it as well. You lurk right in the background, you get the emails and you watch people on podcasts and things like that. Look for consistency, making sure they're saying the same thing, and the strategies are aligned, and they're not doing something different every time you hear about them or something like that. But that I always think it's different when you actually invest. When you actually invest with somebody, just the relationship is different. And so it gives people the opportunity to invest, kind of be part of it and see things from the inside. And then, ideally grow with you over time, that kind of thing. We always like to say like short-term investments, because really like the income fund, the private credit fund on the SFR side, that's between a 1 year and a 3 year investment. And then The land fund, those deals could be exited as early as 2 years, and on average, probably closer to 3. We tell everybody to look at it as like a 3 to 5 year investment, just to give some flexibility. Sometimes with certain municipalities, things can take longer than others. So even in the grand scheme of things, that's not a terribly long amount of time. Sometimes you'll see a lot of syndications, nowadays, especially, 5 to 7 years or even 10 or more. So we try to do things in the sense of, short term, for an investor, but we're really looking for a long-term relationship. For our perspective, this is what we do full time. We want to grow the portfolio. There's a lot of efficiency that comes in with scale. Even in the SFR space, I think that's one thing that, you hear a lot of, people scaling up the multifamily, because of the efficiencies and things like that. And I agree. I think for most people, that's a fantastic thing to do, because managing single family at scale takes a certain team, and certain people and resources to be able to make that happen. So I think for a lot of people, the multifamily side does make a lot of sense. We're kind of set up to be very successful from a scattered site SFR perspective, but it's just one of the reasons that you do what you do is to scale it up. Is to get more assets under management, and there's a lot of that's not just to make more money. There's a lot of efficiencies that come along with that as well from an operational standpoint, where you can really start to put good people that you can pay a great salary to, that are going to be happy and want to stick around with you in the right place, and that also just helps everything in the long run. So I think that's one very important aspect to the single family space that sometimes get lost. This economy of scale is equally as important as it is in multifamily.
Yeah, and I think to your earlier point is, once you have some of that traction going and you've built up your portfolio, that leads to attraction by other people. And so
100%.
you're able to get more quality team members on your team so that you can continue building and growing at a efficient speed, so
definitely
love that. Okay, so Peter, we are almost at time. I want you to give me some takeaways that you have made, or maybe recommendations for people listening to this podcast on ways that they can utilize some of their money. Maybe they have an IRA, maybe they have, some liquidity that they're looking to invest. Like, give me kind of your pitch, and then tell us how people can reach out to you if they're interested in learning more about the syndications that you have.
Sure. Well, I would say, and it's funny. I think I posted it this morning on LinkedIn. I'd say start with the fundamentals. I think it's so easy to get lost in, overcomplicating things and way overthinking things. And, like I said before, for us, I'm very dialed in on single family. I really like single family. I think the dynamics in it long term look better than almost any other asset class. And like I said, there's so many different ways to skin the cat within single family. So I would advise you do something similar. Pick an asset class that speaks to you in some way, shape, or form. I'm not saying it has to be single family whatsoever. If there's something that you like, because enjoying something that there's something to account for that. You know what I mean? So ideally you pick something good. If you pick office, you better have a good place to do it. There better be some, very good business plan around it or something like that. Not that there isn't, my God, there's some office here where I live where there's no vacancy at all. It's a great location, that kind of thing. But pick something that interests you, that you can really spend a lot of time doing, because this is the kind of business where, like I said, I've going on 11 years. I'm still learning things every day. And then don't educate, don't be afraid to network. Like, it's all starts with people. When it comes back to the fundamentals, if you're investing with the right people, whether you're an active investor like myself, or you're a passive investor, like somebody who would invest in our funds, it all comes down to people at the end of the day. Because everything else kind of falls in line if you're investing with the right person. Because like the other fundamentals when it comes to the market and the asset class, like we were kind of just talking about a little bit, the business plan, the underwriting, because that's where a lot of people get tripped up is, when they don't even realize like a sponsor's giving them underwriting that isn't rooted in reality whatsoever. I mean, they have these crazy assumptions, on what appreciation is going to be, from a rent perspective, or depending on what the strategy is, or they have these, it's always they're getting the comps aren't right, they're overestimating what it's going to be worth, or the expenses are underestimated. I mean, it's usually one or the other, right? So if you're with the right person, then they shouldn't be doing that. You know what I mean? So it's just like, I start with the people. In my mind, that's how I've always done it. That's what I'll continue to do. You know what I mean? Start with the people, and there it takes time. You know, it's about conversations and stuff like that. And I think a lot of times, in today's world with the social media and all, it's just, we want, don't, just because you listen to somebody's podcast or their blog, or you read their blogs or something like that, it doesn't mean you know them. Don't be afraid to get on a phone call, try to set something up, meet them in person if you can, all that kind of stuff, and just have a relationship, have a conversation. And, that would be my say, where to start. That's what I would suggest.
Awesome. Okay, so Peter, if people are interested in getting a phone call with you or
Sure.
learning more about you, how can they reach out?
Yeah, so GSPREI.com. There's a contact page. You can schedule time with me right through there. I think my phone number is on there as well. I'm pretty active on LinkedIn. All my contact information and a link to the contact page and all is there. So GSPREI.com is a great place to get started.
Love it. Love it. Awesome. Well, Peter, thank you so much. This was a really great conversation. I think that you are providing a lot of good value. And I think that, understanding, like you said, things that actually interest you, that make you excited, that want to learn more about.
That's going to make it so much easier. Well, and Mallory, too, you hit the nail on the head with the value thing. You know what I mean? Don't forget that piece as well. I mean, and that starts with kind of knowing yourself and what you're good at.
Mm-hmm.
And then when you network and you talk to people, you're not just taking from them. You know what I mean? You're looking for ways that you can add value to them. Mm-hmm. For me, it was, the fundraising and structuring and stuff like that. So find what works for you, maybe what you have experience with and that kind of thing. And then, look for ways to add value in people's life.
100%. And I think that's the best way to sell yourself is, looking at, I have this value, how can I help you versus how can you help me? And that's
100%.
The best way to approach it.
A lot less friction that way.
A lot less friction, 100%. All right. Well, that wraps us up for another episode of Inspire Wealth. And if you are interested in getting some more information about basically educating yourself, like Peter had said, check out our course that we'll be launching October 1st at inspirewealtheducation.com. And it basically walks you through all of the pathways that you can start investing in real estate. Peter, thank you again. And I am Prof M out.
And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.